Hello and welcome to the World Built Environment Forum webinar series. My name's Simon Rubinsohn. I head up the economics team here at MRICS. Today we're going to have a conversation about the commercial real estate world and really try and get to grips with what's going on given the various factors in play, whether it is interest rates, tightening lending standards, or in some cases just a resilient market, particularly on the occupier side. So some of the issues that we're going to be discussing. I've got an excellent panel with me today to help us navigate through these issues. And I want to introduce them first. So in turn, I have Jens Böhnlein, who's Global Head of Asset Management and Sustainability at Commerz. Jens, welcome to the webinar.
Thank you.
Alongside Jens, we have Simon Durkin. He's Head of European Research and Strategy at BlackRock Real Assets. Good afternoon, Simon.
Thank you, Simon. Good afternoon. Delighted to be here.
Pleasure to have you. The third panelist is Faisal Durrani. He's a partner, head of Middle East research at Knight Frank. Hi, Faisal. I think you're. And the fourth panelist this afternoon, very pleased to have Sklar. She's a board member for Nuveen Churchill Private Capital Income Fund and 17 Capital. I think it is actually still around midday in New York, isn't it? So it's actually a good morning to you, Didi. Thank you. Okay, well, before we start the panel discussion, I would like to also introduce one of my team as the senior economist in the economics team, Tarrant Parsons. And Tarrant is going to give us a few headlines from the Global Commercial Property Monitor, which for the first quarter, which was released this morning. This is a quarterly survey that we run. It's purely based on sentiment, but it typically gets somewhere between 2,000 and 3,000 responses from our ICS members across the globe each quarter. And it has quite a lot of influence with policymakers such as the ECB, the Bank of England, and indeed it's been used quite frequently by the IMF as well. So over to Tarrant for a summary of the results for Q1.
Thank you very much, Simon, and hello to everyone joining the webinar today. As Simon said, for my part, I'll be taking you through some of the highlights from the latest results of the Global Commercial Property Monitor. As ever, there's a lot to take into consideration when it comes to the broader macroeconomic environment in different parts of the world, and I think the survey feedback is really useful in informing us on how this is all playing out, and perhaps more importantly, in giving us a real great insight into how key variables across the commercial real estate market are expected to develop going forward. So I think a good place to start is to look at the headline Commercial Property Sentiment Index, which is our summary indicator, if you like, incorporating many of the metrics tracked in the survey into one composite measure. So at the global level, the latest reading came in at -11, so it's still in negative territory, but not quite as downbeat as the figure of -15 seen at the back end of last year. Now, if we break this down into broad regions, Asia Pacific this time stands out as seeing quite a noteworthy improvement in Q1 results. So the index registered a reading of -4, and although this is a level that we would say is more consistent with a stabilization rather than a really buoyant picture, that is up from a deeply negative reading of -21 last time. Now, driving this improvement, it is mainly China, where the headline index moved from -44 to -7, so representing quite a substantial improvement there. So APAC, which had been lagging other world regions over the past year, now appears to be on the verge of more of a recovery story. Alongside this, the Middle East and Africa is still the strongest performer in terms of this headline gauge, so posting a reading of +7, which is more or less unchanged from last quarter when it was +8. So no longer accelerating, you could say plateauing perhaps, but still solid nonetheless, and the only world region in positive territory for this indicator right now. Saudi Arabia and the UAE leading the way there still, which has been the case for a while now. For Europe this time, we still have quite cautious results overall. So the sentiment index posted a figure of -18, which is only marginally less negative than the reading of -21 previously. Most of the larger markets within Europe are still relatively subdued, suggesting that the sector is still kind of struggling for momentum. But overall, the tone is slightly less downbeat than before. And then finally, across the Americas, well, this is the one region where the composite index moves a little bit deeper into negative territory. So last quarter, we had a reading of -9. This time, it's -14. And the United States is, for the most part, driving that slight deterioration. Not all that surprising given the concerns over the impact of higher interest rates, what that's having, the impact that's having on banks' deposit bases, given the collapse of SVB and Signature Bank. And I think that whole episode was bound to have, at least to some degree, negatively impacted sentiment in the commercial real estate sector, and it seems as if that has come through in the latest results. Moving on to the next slide. So on the point of interest rate changes and the general tightening in the lending environment for commercial real estate, the survey's indicator on credit conditions, perhaps unsurprisingly, remains firmly negative at a global level. So as you can see, changes in credit conditions are strongly correlated with the series on investment inquiries. And by the way, both of these are shown in net balance terms, which is more indicative of a rate of change rather than any kind of outright levels. But with borrowing costs becoming much more expensive alongside significant rises in bond yields, I think, of course, this is, all else being equal, going to place downward pressure on investment activity, which is what we've seen at the global level. The fact that the latest reading for credit conditions is somewhat less downbeat than in Q4, and the same goes for investor demand, it may suggest that the peak or the most intense period for this challenge has passed. That could be the case, but in reality, I think that's going to, in the end, be determined by how the broader inflation picture evolves from here, and if that allows central banks to pause or eventually unwind some of the tightening seen over the past 12 months. I think it almost goes without saying that is still the biggest question for the outlook, particularly so when it comes to investment activity. And then alongside this, Simon mentioned earlier, but I would say that up until now, many of the general trends on the occupier side of the market, they are or they have been more resilient. So a lot of this seems to be in keeping with the still quite solid picture for labour markets up until now, at least, and tenant demand has not fallen in the same way that investment demand has, although there are pockets of weakness in some retail and office markets due to the structural challenges affecting those sectors. Moving on to the next slide, please. So if we look at expectations for the coming 12 months, so this narrative, a more resilient occupier market versus the capital or the investment side, I think that's backed up further. So in total, there are 8 national markets that have a negative rental growth projection. So this is at the all sector average level. So that's illustrated by those markers that sit to the left-hand side of that vertical axis there. And by way of contrast, 20 countries have negative projections for capital values for the coming year, and that's depicted by the labels that sit below the horizontal axis there in the bottom half of the chart. So that's an interesting kind of divide. There's also quite a strong geographical divide, which I kind of alluded to earlier with the headline index results. So the top right quadrant, which encompasses those countries where projections for both variables of rents and capital values are positive, that's largely, not entirely, but largely made up of markets within APAC and the Middle East and Africa. The contrast to this is the bottom left quadrant, which includes the countries where both values and rents are expected to fall. And so those are predominantly European markets, as well as the United States being quite a high profile example, just about fitting into that most most pessimistic quadrant. These aren't the deepest negative readings by any means, but still more on the downbeat side. Again, just another piece of evidence pointing to conditions remaining most challenging in those markets, so European markets and the United States, over the year ahead compared to other parts of the world at this stage. Moving on to the next slide. So the final chart here that I want to share with you just illustrates how perceptions on the outlook are really varied across different sectors right now, with the more traditional segments of the market falling behind in some instances. So from a global perspective, capital value expectations are much firmer across some of the alternative sectors. So data centers, leisure, life sciences, all of those display among the more kind of upbeat projections on a comparison across all of the categories covered here. For capital values, we're looking at the purple bars. So what is really pulling down the headline averages, because they are such significant portions of the market, but secondary retail and secondary office values, they are seen coming under significant pressure, further pressure over the year to come. Another point that's emphasised by this graph is the outlook for rents appears much more solid at this stage than for capital values. So comparing the purple bars with the turquoise ones. So if we take, for example, the prime industrial sector, which is still slightly positive here with regards to values at the global level, but that has only kind of just recovered this quarter from a sharp decline in some of the larger markets during the closing stages of last year. Of course, industrial properties or logistics posted very strong gains throughout much of the period since the onset of the pandemic, but with bond yields rising very sharply towards the end of last year, this really triggered repricing of these assets, which, if we look at the UK, for example, was very significant. So there was a near 30% drop in industrial values between June of last year and February just gone. That's according to the CBRE estimates. But if you look at the whole picture, that adjustment was not really proportionate with changes in underlying occupier market kind of fundamentals. Okay, tenant demand has lost some momentum amid the slowing in economic growth more broadly, but the outlook for rents, as you can see, remains clearly positive given the balance between limited supply and still reasonably solid demand conditions for industrial. So at this stage, it is higher interest rates, the whole repricing across the spectrum of asset classes that has hit commercial property capital values in a lot of cases, while the rental outlook has not softened all that much over the past 2 to 3 quarters. And I think that's quite an important distinction to make, I would say. And as a result, rental growth projections sit above those for capital values across every sector covered here, and that really is quite rare. In fact, going back over the past decade, this is the only stretch of time where rental growth projections have been above those for capital values at the headline global level. So that's been the case now since the third quarter of last year, which just I think goes to confirm how important the outlook for interest rates is when it comes to prospects for capital values beyond this year. If we see interest rates cut next year by some of the world's largest central banks, which is still the view of a lot of forecasters, although admittedly it's very difficult to call that right now, but any unwinding of the recent tightening in policy, you would imagine would then strengthen the outlook for commercial real estate valuations once again. But until then, we seem to have this picture of a more resilient backdrop on the occupier side relative to the investment side, which is quite a big feature of these results. So those are the kind of the main takeaways, that highlights from the Q1 survey. Thank you for your attention, and back to Simon.
Okay, thank you very much, Tarrant. And now I really want to bring in the panel on the back of that. But just as they're sort of getting their cameras back on, what I was just also interested in, I will come back to it perhaps in the course of the discussion, is the sort of the signals from that survey about the polarization between prime and perhaps secondary, or the best and the rest type thing, and perhaps we can come on to discuss that in due course. Before I turn to the panel, I just want to remind the sort of people who have dialed in, all the attendees who've dialed into this webinar, that we really want this to be as interactive as possible. We really love to get your thoughts. If you've got thoughts, or if you've got questions that you want to put to the panelists, or indeed to Tarrant, do use the chat function here and get your questions in, because I think it will really make it a more interesting conversation. But just taking the lead from, I think it was the penultimate slide, and perhaps I'll start with you, Jens, about Europe, because the sort of feedback Tarrant was describing that we're getting from Europe, where we get pretty good responses, was a bit downbeat still. So there was a real contrast, and we'll perhaps come on to North America as well, but a real contrast between the tone of European responses and perhaps the responses from some parts of APAC and indeed the Middle East, and we'll come on to that in a minute. But what were your thoughts about the European type sort of numbers that we saw there?
Well, somehow just confirms the gut feeling which you've developed over the last couple of months. I mean, we see a market which is in some stressful environments for some areas, but still we see rental growth in some areas. And I mean, I think it's fair to say that prime offices or prime retail is still working, and just particularly in Europe, I mean, where you have like some very strong economies, or you have that very close vicinity, so people do not have to commute very long, so you have like that idea of 50-minute city already in place for some certain areas. It's still, you know, kind of working, and this is basically one of the key drivers that you have the rental growth still.
Okay, thank you. Let's jump across the pond then. So Didi, what are you sort of, in terms of sort of North America? I mean, you know, again, the numbers are a bit cautious there. Is that what you're sort of seeing and hearing?
I'd say very cautious. So I'm coming to this group from a total credit finance background, running global banking businesses. Really, the client base has been private equity and alternatives. Of course, real estate plays a huge group, whether it's BlackRock or Blackstone, etc. And so I think what we're faced over here, considering that real estate is the third largest sector of investable capital in the US. So in private markets, about 20 trillion. We're at a right sizing for the next 24 months. We have at least 5 trillion coming due because of the securitization market, short-term loans that were originated in 21 that will come due in 23 and 24. $1 trillion of that comes due over the next 12 months. It's an asset class in the US that's demonstrating it is not able to adjust to a high rate environment. So just want to give you the finance aspect first.
Okay, that's interesting. Thank you, Didi. And because I'm a gloomy economist at heart, I'm going to go to Simon next to get the European and UK view from BlackRock. How are you seeing? I mean, how are you seeing things, and how does it sort of compare with the sort of feedback we received?
I hope you're implying you're going to get a response that's less gloomy, Simon. Look, I think I was quite surprised by the sentiment being relatively buoyant in Europe compared to previous quarter. I would have expected it to be slightly more downbeat. And why is that? Well, you know, we're getting lots of conflicting data, and you know, we've got capital decline, we've got strong occupier markets, but you know, we mustn't forget that this time central banks are trying to induce a recession. They're increasing rates in response to rising inflation to induce a recession. And if we take that as if we believe in that, which I think we have to, we can't not see an impact on the occupier markets at some stage. So I wonder whether, you know, we're getting some misleading data from maybe MSCI, which is starting to report sort of, you know, capital value decline has started to moderate. And I just wonder whether the banking crisis in the US, okay, we haven't seen contagion to the extent that maybe we thought, but what it's told us is that there are cracks in the system. That's probably increased the probability around recession later this year. And I just think, you know, occupier markets have to take a hit. There has to be an impact at some point, most likely on the real economy first, and that will impact occupiers ultimately. So I keep swinging from being relatively positive to relatively negative. You know, some signals are relatively positive, yet some of the actual fundamental drivers here are actually still quite downbeat. So I wonder whether we are sort of calling proximity to the bottom a little bit too early.
Interesting, but I think we may well come back to that. And I see Dee Dee's nodding. So before I go back to you, Dee Dee, I think let's get the positive story from Faisal. What are you seeing, and how's the Middle East playing out? You can't. Sorry. While we try and deal with that issue, we've already got the first question. Sorry, Faisal, any joy?
Yes, I'm back now.
Good.
There we go. Sorry about that. So the view from the Middle East is in stark contrast to what the other panelists have talked about that's going on in their respective markets. I mean, if we're looking at countries like the UAE and Saudi, the last couple of years, we've seen nothing but positive growth in occupier demand and investor demand as well. In fact, we've started classing those two economies as the Gulf Tiger economies, borrowing the phrase from Asia from the 90s. Of course, the growth drivers in both locations are quite different. In Saudi, we've got a transformative vision that's been laid out by the government called Vision 2030. And to date, there's more than $1.1 trillion has been committed to real estate and infrastructure investment, which in itself is creating a significant amount of domestic economic activity and is reducing the sort of reliance on global economic growth. And inflation as well, headline inflation in Saudi is sitting at about 3.5%. Clearly, the government is working quite hard behind the scenes to subsidize things, but it is a lot lower than it is elsewhere. There's also various programs and initiatives in Saudi to attract global multinationals to headquarter in Riyadh, which is putting a lot of pressure on the existing office space. We're talking about occupancy levels in prime buildings of circa 97, 98%. And in fact, the main financial district in Riyadh, called King Abdullah Financial District, is fully leased or fully committed. There literally is no space available. Similarly, in Dubai, strong economic growth following the government's decisive and world-leading response to the pandemic has induced a lot of positive sentiment. And that's actually now coming through in all the non-oil sector PMI readings that we're tracking. And the economy has actually been in expansionary territory for almost 2.5 years. So businesses are feeling quite good about life. And that's reflected in the fact that office occupancy levels, again, in Dubai are sitting in the mid-90s% for best-in-class office buildings. So yes, it is a quite different story, but a market like the UAE is a global market. And should there be a global economic downturn, it will inevitably impact cities like Dubai.
Okay, and I'm sure we're going to come back to some of the specifics of those two markets through the course of the remainder of this session. But I mean, we've got an early question in, and I just remind you, please do send in your questions because they will make the conversation that much more interesting. And I mean, perhaps we'll start with Dee Dee, because this question is about the impact or the opinion of how natural and social disasters might impact on CRE valuation. But I'm thinking in your case about how lenders might be viewing, how money might be viewing the risks associated with natural and social disasters. Now, the question has highlighted the European situation of the war in Ukraine, but other sort of perhaps climate-related shocks. And obviously, there's been a few of those. Perhaps arguably some of those in the US over recent years. So I'm just wondering, from a finance point of view, how are you looking at these sorts of issues and the potential impact on CRE?
Well, that's a lot, right? If we start to take in what is being required in many states already with upgrades for energy efficient buildings, but let's let's wait on that because that's a whole thing. Obviously, the weakest link here is office vacancies and office rent. But the problem is that our real estate loans, all of our financing, 70% of it resides in banks that are way beyond the top 25. So the bulk of real estate finance is in much smaller banks across the country. And those markets have been shut. They've been curtailed since probably third quarter 2022. The insurance companies have been opportunistic, capitalizing on higher rates and spreads. Those banks that are in combination with the insurance companies, are only providing financing to their best clients. So, we are tight here. The agencies have been a bright spot for multifamily and affordable housing. But commercial real estate, again, is the third largest by market cap of investable capital here. So we are going through some changes. And I wouldn't say that the banking crisis that we just had only resides around SVB and Signature Bank. There were a couple of smaller banks in addition to them that have gone under already. There'll be a lot more consolidation because I think that the regional bank model has to change. If you look at what caused it, it wasn't necessarily credit, it was a deposit crisis.
Yeah. Okay, thank you. Jens, on the specifics of natural and social disasters and their impact on CRE valuation, is this something that is sort of relevant in Europe?
I would say so, and likely I think it's for the rest of the world as well. I mean, you mentioned it's mostly due to the Ukraine war, and of course, that's those types of things which you have to bring into play and just predict the future. It's not easy because I think nobody has really seen coming it so fast. But if you just take the question around physical disasters, I think that's something we can pretty much predict for the next 20 to 30 years. So from my perspective, everybody who's owning real estate should have a prediction what's going to happen on his real estate. And the results might be surprising actually from time to time. For example, if you look into cities like New York, you will see that the sea level is going to rise by likely 2 or 3 meters if we continue with the warming of the global temperature as we are today. So this definitely is going to have an impact. Nevertheless, I think there are solutions. And if you look into Europe, like the European Green Deal, it has like an idea of a taxonomy compliancy, which just requires you to confirm that you are working against those natural disaster potentials. And this is, I think, something the real estate industry is now including in basically every transaction, and you will have to predict it. And we already see that insurers understand that it's a rich source of data which they can bring into the real estate community. And we are working with those things as well, just in order really to better understand, is that a good investment, or do we have to do something for the next 20 or 30 years? And mostly it's going to have an impact on the value of the asset the moment you're going to buy it, because you want to secure it.
Okay, that's it's really going to be interesting to observe how this plays out. I want to just perhaps move away from that and just focus on something that certainly, I think we're probably all fairly, sort of all still grappling with, and that is the usage of office space. Faisal talked about the numbers in the Middle East still, but I think utilization being pretty strong. I mean, is that correct? Most people are in the office? There's not the fear, is there, in the Middle East about sort of empty offices?
Well, look, I think if we take a market like the UAE, where the population dynamic is 90% expats and 10% sort of nationals, all the expats that move to the UAE for work generally use the workspace as a place to socialize, as a place to make friends. They haven't necessarily moved there to work from home. So that, so we have seen most businesses return to work 100% of the time. But that being said, international companies in particular are having to offer greater flexibility and working from home arrangements, whether that's 1, 2, 3 days a week. Cities in the Middle East are also not as large as they are in Europe or North America. So people aren't generally commuting via trains and buses for extended periods of time. So it's relatively easy to get to work. People want to be there. The way the sort of post-COVID dynamic is manifesting itself is that businesses are gravitating towards best-in-class, or what they perceive to be best-in-class grade A office space, because they realize that an office is now more of a showroom, a way to showcase themselves to future talent, a way to showcase themselves to future clients. So we are seeing that discrepancy in occupancy levels between grade A and more secondary stock. And when the grade A stock comes with ESG credentials attached to it, there are significant rental premia to be had. And whilst the ESG concept is still in its nascency in the Middle East, we are seeing international occupiers chasing after buildings with green credentials because they have a green global mandate to do so. And they're happy to pay a premium for occupying that space, which is in short supply.
Okay, well, that's interesting, and I'm going to turn to Simon next. But I mean, before I do that, two things that happened yesterday. First of all, we had a presentation where someone from CBRE came into our offices, and he said, what attracts me to my office, and I think the CBRE headquarters in London have just been refitted. I shouldn't talk about retrofitted, refitted. And he said it's a fun place to be. So that was an interesting description. And then subsequently, we had a presentation we've got a new occupier group at RICS, and we asked them, to tell us about their experiences in terms of what their employees desire in terms of the number of days they come into work and what the organisation would like. And what we did find was there was this disconnect with this group, which included some pretty big organisations, including sort of substantial multinational companies and sort of public sector bodies as well. On average, I think employees want to come in around 2 days. That probably won't shock anyone, but the employers seem to want 3 to 4 days, and there seemed to be a bit of a standoff. Simon, what are you seeing in terms of office usage in Europe?
Gosh, well, there's some data published last week, and forgive me, Faisal, if I thought it was Knight Frank, it may have been Savills that might have published this. One of the two big agencies over here published the first consistent occupancy data that I've seen for cities across Europe. And it paints a pretty different picture to one that Faisal was just talking about, frankly. Although occupancy has increased in the last 12 months, there's still a huge range between cities that are vibrant and are bringing people back, and people coming back willingly, such as Paris CBD, Madrid, Stockholm, still quite high. They're still around the sort of 60% of the pre-pandemic levels, but let's bear in mind the pre-pandemic level wasn't 100. Versus London, and London City doesn't look great, still sub 50%, and you feel it. I'm in the office now in Moorgate. Come to the office tomorrow, and frankly, our building where we probably have 2,500 to 3,000 people today, there'll be maybe 50 people, or maybe the only person on the floor tomorrow when I come in. And the city really does feel very, very different to 10-minute walk down the road to Farringdon, where it feels more vibrant, and very, very different to the West End, where you'd be forgiven for wondering, well, what crisis? Nothing's really changed. It still feels very vibrant. There are amenities, people are around, and there's a buzz. So it's got that tourist attraction which brings people in, that creates a space. So we're seeing huge dispersion. You're exactly right. Employers want people back more days a week. Employees are less reluctant to come back on average, more days per week. But in a market where the workforce has shrunk and continues to shrink, the demographic isn't favorable in terms of younger people coming into the workforce. And just anecdotally, I was told by one of my analysts, and I would never have dreamt of saying this to my employer 25 years ago. She said to me that if BlackRock changed their mandate from people coming into the office from 3 days to 5 days, she says, I will be leaving because I value my flexibility. It's all I've known is flexibility for the last 2.5 years. And that's pretty consistent with how that demographic, that age group feel. So I think you're exactly right. There is a standoff between employers and employees. And I think employers have to realize that if they want to attract and retain people that they need to grow their business, they're going to have to offer more of what people are looking for and less of just simply what we had pre-pandemic, which is banks of desks. And I refer to this as Manhattan, 1990s Manhattan, lots of mahogany, nice and dark, almost everything that the CBRE new office isn't.
Yeah, I haven't been to the CBRE new office, but I'm just obviously I now need to go because I'm hearing too much good about it.
But interestingly, in that example, Tuesday to Thursday, it is very, very difficult to actually secure a desk.
Yeah, interesting. In terms of how we define, a good quality office, though, and desirable. I mean, Jens, ESG, I would imagine in Europe is a big issue. The ECB is certainly doing quite a lot of work thinking about sort of those sorts of issues. I know I've been involved with a few sort of strands of work there, but thinking about what we define as prime offices now, and good quality offices. I mean, from a European perspective, is ESG an integral part of that?
Yes, I would say so, but I think it's not there yet where it's going to be in a couple of years, because right now things are trending into ESG compliancy. But what we've seen basically was part of the European Green Deal trying to convert investments and cash flow into ESG compliant investments. And I mean, if you look at the office market, and the graphic showed it, I mean, there's, I think, a real push for prime office areas. Secondary and third areas are really going to struggle from my perspective, unless they are not really trying to ramp up with some very specific offerings, which no other office can do. But if you look like into the city centers, where we have a lot of assets actually around, it's, I think, one of the main topics, how we transform those cities into areas where people love to be. And it's not only about just being in the office, what Simon just mentioned. It's just, having something why you should go there. You want to have these amenities all around. For example, if you look in the US, if you do not have amenities in your office space, you're just simply not on the long list of an search of an occupier. And in addition, you have to offer something on top. And that might become actually ESG, but maybe from two directions. One is my kind of, bringing it into a carbon net office environment, so that from a, let's say, operational perspective, you can report on your carbon footprint and how you want to decrease it within the next couple of years. But I believe there's another aspect, and it's about how people are really feeling in the office, how much screen you're going to have, if there's something which is linked to ESG, looking into like 20 years ahead, it will not be about is the office warm during winter. The question is going to be, is it cold during the summer? And are there areas of shading? And like maybe we're going to see some small forest areas in the city center. And the office very likely will not be not only be in the office itself, it will divert into the area where the office is located together with other areas. So to answer your question very clearly, I think it's going to become a major topic, but it will take some time. I think the first movers are going to be the global occupiers who will just ask for that demand. And you have to actually tick the box on prime location. So location is going to stay, but on top you have to deliver ESG and carbon net. So I think that's what we're going to see in the future.
Yeah, and you sort of mentioned, I think in your first comments, your initial comments, 15-minute city. And I know obviously Paris has got a big discussion around that, because we've just got a comment in here where someone was saying, you know, we need to rethink the location of workplaces as leases expire so we can rebalance cities to better manage quite busy areas. I think that they must be London based, because they're talking about the horror of the tube in rush hour. But I'm sure that you know, public transit generally can be quite, you know, wearing in busy times. So I'm just wondering, you know, how that process evolves.
Yeah, I think this is something which we will see in many of those large-scale cities. It's about actually offering something. So I think there's going to be a really huge decision to get young talents into the cities. And those cities will basically define whether you're kind of an investment market or not for the next years to come. For example, Barcelona is working on some, let's say, interesting models, how they can just take out some streets and give them back to pedestrians, just by, you know, adding some trees and flowers and opening it up for whatever it's going to be. Maybe it's bicycles, maybe it could be drones, I don't know. But I think you will see that in many cities across Europe. And I think that's a big differentiator as well from the US. I mean, if you go to New York, commuting is like, if you're good, like 15 minutes, but usually it's an hour or 3. In Europe, usually if you commute more than an hour, it's already very long. And if it takes you like half of your day to commute to the office, then you will think, you know, is it worth it actually to take the time in the train to go to the office? And just to finish this one off, I think we will see kind of merging the spaces where people live and people work closer together. So maybe that's also an opportunity for some of those offices which you may not need in some areas in the cities, even so most people will not want to hear it. But I think that's the reality we're facing, and convert them into some multiple spaces where you have residential as an additional offering.
Okay, that's a good answer. And you know, obviously, Didi, New York was mentioned there as a long commute, or the US was mentioned. I think New York specifically, perhaps. But I'm also wondering, you know, from a finance point of view, is it, you know, are you really thinking very carefully when you look at offices? Are you thinking carefully about sort of the sort of whether it is, you know, that polarization issue that, you know, there are going to be these developments which, you know, these sort of secondary assets which really, where the value is just not going to hold its own going forward? Is this something that really weighs on your mind?
Well, I think in New York, since COVID and even starting a little bit before, lots of the firms, whether it's Goldman Sachs, they had their operations moved into New Jersey, right? And then we've had taxes influence a lot of movement in New York to Florida and other more tax efficient states. But with private equity and the banks and the accounting firms still wanting locations here. So reevaluating their space, moving to new buildings, taking less space, staying in the same buildings. And we're trying to come up with the fact, how are we going to handle the fact that only 1% of buildings that need energy, ESG improvements can be repurposed, period. And that goes for cities like San Francisco and some in Boston and Chicago as well. So I think people are still waiting for the bottom to fall out. Investors will be the long-term horizon investors, the pensions and the insurance companies. And we have some other solutions that are becoming very active, not new, but C-PACE financing to finance a lot of these improvements in a cheap capital sort of way for operators to see if they can use it. But as far as the young community, you know, I sit on as a founding member of the Women in Real Estate Steering Committee for KPMG. And I am a founder and remain the global head of a global organization called Women in Fund Finance. So we talk about this, what is happening to careers and where are people going? And there are a lot of new alternative careers in real estate around technology, right? And those type of jobs, they can be done from home. They can be done, you know, not in the office every day. But I do think that the banks, the accounting firms, even the real estate firms like Cushman & Wakefield or, you know, whatever, they need that time in the office. You cannot learn, you cannot figure out solutions, you cannot really rely on your own structuring unless you're with a team. I think in real estate, it makes it harder because we had, you know, 0 interest rates here. And we had a lot of financing, a lot of building, a lot of growing of teams. And now we have that being a major expense with less revenues. So I think we're about to see some changes. When we came out of the global financial crisis, people talked about the malls. What are we going to do with all the malls that we had? Now we talk about what are we really going to do with the older office buildings in major cities, and some of them may be coming down in order to make ways for new ways of living, more green, and, you know, more residential, which will be compatible with office. So I agree with all that.
Okay, thank you. Now, I just again remind you that we really do want your questions and comments, so keep firing them in. A quick one for Simon on the back of this. I mean, repurposing, I mean, I think that word was used. I mean, I don't know, there clearly are some challenges with repurposing some buildings. I mean, RICS did a report a few years ago about the permitted development rights when they were first introduced on offices in the UK, and about the poor quality of some of those bits of work, the redevelopment there in those buildings, and some, I suppose, some buildings perhaps are just not going to be, you know, particularly, it's not going to really add up to do that, what the repurposing effort. And I sort of wonder, you know, what has BlackRock done any analysis in terms of stranded assets, or the potential for stranded assets to become a real issue for the market, and indeed for the financial sector?
Yeah, just the first part of that question around repurposing. I mean, it's incredibly challenging, and I read the report that you're referring to. I mean, you know, these buildings typically were never designed for human habitation, and they are strewn with challenges, technical challenges, locational challenges more often than not, and they often end up delivering a pretty poor product. And there's a lot of reputational risk around doing so. And there's been a lot of instances where, you know, certain demographics have been housed in these buildings, very, very poor quality. You wouldn't want to be the owner of one of those assets, because I think the reputational risk is very high. Now, in terms of stranded, I guess yes. I mean, we will see more stranded assets. Depreciation curves are steepening. It's partly ESG driven. It's partly driven by occupier demand being less than what it was, but being focused far more on very, very specific submarkets that offer something more than just a place of work. So by definition, there will be lots of assets that will be, inverted commas, stranded, but for different reasons. And to Jens's point earlier, around the livability of places, I completely concur with what he was saying. I think the future of cities is going to be far more mixed use than maybe it has been, and I do worry about submarkets such as the City, Canary Wharf, to a point, where actually they've traditionally been office anchored. So what is the future going forward? It's about bringing people in, and it's about increasing dwell time. The City of London, even on the Monday to Thursday, Tuesday to Thursdays, typically after 8 p.m, people leave, as it always has been. It has been for the last 30 years that I can remember. If people lived in the city, that would create far more 7-day-a-week dwell time, more vibrancy within an area. So I think the definition of a core location will start to change quite rapidly over time as people's demands and needs change.
Interesting. Thank you. I now want to turn to retail, because I actually read a report. It was about UK retail, suggesting that we may have seen the worst of the fallout from retail. I want to come on to the sort of the more advanced markets in a bit, but I thought, Faisal, I mean, I presume that the retail story is very different in the Middle East.
It is and it isn't. First of all, just like everywhere else in the world, the retail market was hit pretty badly by COVID and lockdown restrictions. But what we're seeing, as we've seen elsewhere in the world, is a huge pivot towards experiential retail. Landlords of shopping malls, mall operators, retailers, all looking for ways to boost those dwell times and boost traffic. I'll use Saudi Arabia as an example, as that is one sector that has undergone a pretty massive transformation in the last 6 years since the National Transformation Plan was unveiled. What we're seeing is the rise of developments that are classed as lifestyle retail developments, where the focus is on food and beverage outlets as well as entertainment, and that is typically manifesting itself in the form of cinemas. And we recently published our annual Saudi report, where we surveyed 1,000 Saudi national households. And what's interesting to see is when we spoke to people about the sort of preferred format for shopping, where do you like to go shopping? Surprise, surprise, shopping malls are still very popular. But once you start segmenting that popularity by age, what you find is it's popular amongst people over 45. But least popular amongst people under the age of 24. And when you look at what that Gen Z, those under 24s, like to do in terms of their shopping, the vast majority of them actually like to shop online. And in Saudi, about 60% of the population is aged below 35. So that is where the future demand is going to come from. And that shift in shopping behaviors can have huge ramifications for any shopping mall developments that are planned. Currently, we're tracking about 4 million square meters of new retail developments across Saudi that's due to be delivered by the end of this decade. And so we are seeing not necessarily the demise of bricks and mortar stores, but a focus on creating a unique experience in store, a store that offers perhaps the customization of goods, incorporates a small cafe or another F&B element. So that is what we're seeing there. But for a market like Dubai, which is the world's most visited city for 2 years running now, we see a completely different story. It's being driven by the tourists that are coming in, and retail is continuing to expand. And the city boasts some of the biggest and fanciest shopping malls in the world that are doing extremely well now that we're coming out of the pandemic.
Okay, thank you. Now I'm going to jump around because some questions have come in. Needless to say, it's always going to be a bit of a rush now, juggling around. Look, Simon, I just want to quickly go back to you because one of them is specifically on the UK. Why are not more shops on the high street being repurposed to residential use? There are far too many shops on the UK high street. Is the point being made? What do you think?
Absolutely agree completely. Why is that not happening? Or maybe there's maybe landlords, owners are not yet realizing the true value, or don't want to realize the true value of some of these assets. But I believe that the future of cities, town centres, is about bringing people into those town centres. And I wonder whether the trend of flexible working, 2 days per week on average, actually being outside of the place of work, is going to shift more demand back to local high streets. That's question mark. I suspect, but I think that could be a positive for high streets. Yes, there is too much retail. We're over retailed. But that's been the case for a while. It's just been accelerated by COVID.
I suppose for London, as one of the big issues is going to be whether or not the Marks and Spencers on Oxford Street is allowed to be knocked down and rebuilt, isn't it? Because that will change the nature of that building, and that might set the tone for other central London developments, presumably.
Yes, absolutely. And Faisal's point about experiential retail, that is the direction in which most retail is heading. But let's remember, a pound spent online or a dollar spent online is not a dollar lost from the high street. You know, the interaction between physical and digital is only going to increase.
And Jens, I've got a question about the EU here. Someone's asked, you know, about the future of co-working spaces in Europe.
I believe not so bright as you may believe. I mean, we have seen that there was a big decline during the COVID phase. We are very well restrictive on having co-workers in our portfolio. I think there's still kind of an opportunity for them to operate, but most of the time, I think people just want to actually enjoy being in the office. I mean, there's a sweet spot for some of those operators to work with that, but we see less space actually that is required in the large cities. And I personally believe that some of the landlords will work on some models how you can offer smaller suites, smaller spaces or smaller units to occupiers, and the future is very likely not sitting on a small desk which is 80 centimeters together with other 8 people in one small room. So I mean, why would you go there if you have the, you know, maybe a much better space at home? So yeah, let's see. But I think it's going to be a shift there.
Okay, and Didi, a question just a bit more about that's coming about finance. Just trying to understand who. Well, I suppose it's more about who the buyers are. Who are the investors going to be going forward in this? You know, looking at global real estate.
I'll answer that, but I just wanted to say that I recall in the late 80s going into a Deloitte office, and it was run like a hotel. Right? If that person from Deloitte was going to be in town that day, they pulled out a box, had family pictures that was all kept there in New York, right? Then I went to London and I saw that in private equity. I think the first was Prudential Private Equity. Its offices that it rented out were like that. I'm seeing that more and more. So even in the banks, whether it's JP Morgan or Wells Fargo, where people are coming in 3 to 4 days a week, there's some place where they're keeping personal stuff and they are sharing that desk. You see it at Goldman, you see it everywhere. But, you know, give me your question again, because I was thinking about that space.
Yeah, no, it was just about where the big buyers are going to be for real estate. You know, where,
without a doubt that people, and you know, I'm coming from a world where I was leading a business, call it 1 out of 150 banks, and we had a finance portfolio of $250 billion with 65 of hold and the rest syndicated with other banks. Right now, those same institutional investors, which totaled 2.7 trillion all strategies in 2004, now total $85 trillion, all strategies, not just real estate. These long-term investors, whether they're from the Middle East or they're from Asia or they're from the US, are going to be the solution. And that is why you see Blackstone having raised the largest real estate fund ever, with a total focus. They know exactly where they want to be, logistics and data centers. These solutions will come from those people. They have pensioners they need to pay out for lifetimes, and they will be the answer, as well as, you know, some of these solutions like C-PACE financing, which you will see in a lot of your countries coming forward.
Okay, thank you. We're almost at the end of this. I just wanted to have a quick run through as top tip for the next year. Where do you place your bets? So just going in the order that I can see you. Simon, any thoughts? Top tip?
Top tip, I'll be contrarian. Out of town retail that supports click and collect.
Okay. Well, I did read that report telling me that retail had probably seen the worst of it. So I wonder whether that's part of that story. Faisal?
Prime office space in countries like Saudi Arabia and the UAE, simply because we haven't got anything in the pipeline. And if we do, it's already committed.
Okay, great. Jens?
I would actually go with prime office spaces as well, but with a kind of a mixed use approach and more integrated into the city.
Okay, thank you. And finally, Didi, last word.
I would say the upside is going to be who can increase rents. And I think that is going to be multifamily apartments. We're not going to see an increase in rents in office space. Industrial can only grow so much, right? So I say office is not the bet in the US. It's going to have to be repositioned and evolve.
Okay.
But I would put my money, and I have, into whether it's corporate debt or real estate, short-term loans in the private markets. The non-bank lenders will be the solution for financing.
Okay, great. Well, that's a great point to finish off on. Look, let me first of all thank my 4 panelists. Thank you very much for your participation today and contributing so freely. Also, thank you very much, Tarrant, for your presentation, which I think set the tone really well for the subsequent conversation. And of course, thank you all for dialing in and indeed contributing with your questions and indeed your points. So freely again to help facilitate what I think was a really useful conversation. So just as I finish, a quick reminder that we will be publishing a recording and a written summary of this particular webinar online, and of course we'd like you to feel free to share either of those or both of them with your professional networks. At the end of the presentation, there will be the opportunity for you to give us your thoughts as to what you felt about today's webinar. And certainly we would welcome you completing the online poll, because it's by doing that that we really understand what's of interest to you and we can gear future webinars around that. I did want to just remind you that there are a few other webinars scheduled for the rest of this year, and include WebEx webinars and indeed some conferences coming up as well. And you can see the conferences towards the back end or the middle part of the year and through to the back end, and some other webinars, very much more specific webinars there earlier on. But please do sign up for these. I think they all look like potentially quite interesting. And obviously you can follow us, as we've mentioned before, on various social media platforms like Twitter, Instagram and LinkedIn. There is also, I believe, a podcast series. You can have a listen to that and let us know what you think. So look, I'm going to finish off. I'm 2 minutes over, so I feel that I've not really managed this as well as I should do. But thank you all again for participating and look forward to seeing you all again soon.